All right, in this video, we're going to go over intra-entity transactions. In particular, we're going to go over inventory. Now, again, this video is going to give you a baseline or a foundation to what we're going to talk about in the next video. So to kind of give you a little background, in this video, we're going to talk about a situation in which a parent sells a subsidiary inventory, and at the end of the year, all of that inventory hasn't been sold. And when I mean all of it, I mean 100% of it. This is going to differ in the next video, in which we're going to talk about a situation where the parent sells the subsidiary inventory, and then that subsidiary sells, let's say, 60% of that inventory, which means there are still 40% left in the subsidiary, and we're going to need to back out a percentage of profits. So again, in this video, we're going to talk about as if the subsidiary has purchased it, but at the end of the year, they haven't sold any to a third party. Remember, we're talking about where we have a parent and a sub, and we cannot consider the gains or the net profit of that inventory until it's sold to a third party, thereby not selling it to just a subsidiary, but the subsidiary's customers, okay? So we've got a lot on this board here, and we'll go you through each one of it. The one thing that I want to caution you is that we're going to make a whole bunch of these consolidated entries, and they're not going to make sense on the onset. But the note that I have up here is we're going to play with some accounts that won't make sense. Remember that this is only worksheet entries, not actual entries. So the entries that we're going to be doing are only worksheet, which means they're not going to have an actual effect on the financial statement, the individual financial statement of the companies or the individual books of the companies. So when we consolidate, we're going to do these entries on a worksheet, and so it may be okay that we're pushing a number, an account, we're debiting an account which we would normally not debit unless a transaction actually occurred. Okay, so remember that as we go through this, and then hopefully I'll do my best to walk you through it. Okay, so let's first talk about our example here. Let's assume that we have a parent and then we have a subsidiary. Okay, and so let's say the parent sells $1,000 worth of inventory to the subsidiary. Now that parent purchased it at $500. So $500 sells it to the subsidiary for $1,000, thereby having a net gain of $500. So what would the entries be? Well, we know from financial accounting that we would debit accounts receivable for $1,000, debit sales revenues for $1,000, and in addition, we have to account for the expense. So we're going to debit cost of goods sold for $500, which is what it costs the parent to acquire that inventory, and then credit inventory because the inventory is no longer in our books for $500. That's what we would see on the parents. Now, on the subsidiaries, we would see them book the inventory at $1,000 and credit the accounts payable for $1,000. Now, a couple things that are working here is notice that we have a step up. The inventory used to be on the books for $500, but now that I've sold it to the subsidiary, it's now on the books for $1,000. If they are truly a parent and a subsidiary, we can't have that. We can't just have them step it up based on an intra-entity transaction. So we're going to have to eliminate that somehow. Now, the first way that we're going to eliminate, and the first thing that you're going to do in all situations, is the Consolidated Entry TI. Okay, so Consolidation TI you will do anytime there's an intra-entity transaction, regardless if the inventory has been sold or not. Okay, so the purpose of Consolidation Entry TI is to remove the sale of the goods and remove the cost of the goods sold. So typically what we would do in a consolidation is we would add up all of the parent's inventory, we would add up all the subsidiaries' inventory on a worksheet, and then add it together. Consolidation Entry TI removes those sales, okay, between them, and moves those costs of goods sold between them. Okay, so we're going to remove the sale of the good and we're going to remove the cost of the good. Now, we literally could just reverse the entries that we originally did. Okay, we could do that, but we don't. In consolidations, we follow TI, and then we'll talk about G in a minute. So the one thing that we have to remember is that we must remove it in the year of the transfer. So what we would do is keep track of our intra-company transactions and at the end of the year reverse them out. Okay, this is both for downstream and upstream. Again, we haven't talked a lot about downstream and upstream. We'll talk about those in other videos, but just assume for now downstream and upstream both works the same way. So what do? Well, the first thing that we're going to do is we are going to back out the sales revenues. Okay, so we're going to back out the sales revenues by debited sales revenues. Notice if I had a credit here on the parent, the way that I would get rid of sales revenues is I would debit. So for consolidation entry TI, we would debit sales revenues. Now here's this asterisk right here. It may not make sense now, but it will in a minute. We're going to credit cost of goods sold for $1,000. Now you might say, hey, why are we crediting cost of goods sold for $1,000 when they're on our books for only $500? And the reason why is because we're going to reconcile those in consolidation entry G. So at the end of the day, we're kind of fictitiously putting $500 in cost of goods sold, but then we'll find a way to reconcile that out when we do consolidation entry G. So follow me for a minute and then we'll get to there. So debit sales revenues, credit cost of goods sold, TI, that removes that, okay? And then we're done, okay? Now, let's talk a little bit about consolidation entry G. So this is done at the end of the year no matter what, and then we're done. Then at the end of the year we go, okay, subsidiary, how much inventory of ours did you sell? In this case, they've sold nothing. And because they've sold nothing, we're going to have to back out the gain. Okay, so we're going to back out the gain, but we're also going to back out the overstatement of inventory. Remember, inventory combined should be $500, but what happened here? We took out $500 and we made it $1,000, okay? So we're going to eliminate the step up basis of our inventory and we're going to take out the gain. So how do we do that? We are going to debit cost of goods sold, and by debiting cost of goods sold, what we're doing is we're kind of reconciling this up here, okay? And we're reconciling this right here. So all of these G's here with cost of goods sold, we're literally reconciling, and if you notice this, we had a credit of cost of goods sold of $1,000, we have a debit of a cost of goods sold of $500, and we have a debit of a cost of goods sold of $500. So that at the end of the day, if we took all of those three, it nets to zero, as if the transaction never happened. So right here, when we said, hey, we're going to step it up to 1,000 even though we only have a 500, the reason why we're going to do that is we're going to make the adjustment here, okay? So that nets to zero. We have a credit of 1,000, debit of 500, debit of 500 nets to zero. Okay, and then we're going to credit inventory for $500. We're going to credit inventory so that we can remove the overstatement. What do we mean by overstatement? Well, inventory right now is at 1,000. How do we get rid of it, or how do we bring it down back to what it should have been? We would credit it by $500. Okay, so consolidation G's job is to eliminate the overstatement of inventory. We eliminate the overstatement of inventory by crediting inventory, and theoretically what we're also doing is we're removing the gross profit by debiting that cost of goods sold, which then removes those three entries. Okay, now going back to the very beginning, we said, hey, why don't we just reverse all these entries at the end of the year and then we would be fine. You could do that, but in a previous chapter we talked about consolidation entry P. Okay, and in consolidation entry P we said that would be the reversal of any payables and receivables by an intracompany. So notice that this is due from the subsidiary, this is due to the parent. If we just follow our consolidation entry entries that we would have to make, we know that we would have canceled this anyways in our consolidation entry P. So that's why we don't just reverse them up. We could, but we don't, because we already have procedures in place to remove intracompany intra-company receivables and payables, and therefore we have to deal with the rest of this, okay? So hopefully that makes sense, but at the end of the day, what we did was we did two things. First of all, we removed the sale and the cost of goods sold by doing a consolidation entry TI, by debiting sales revenue for 1,000, crediting cost of goods sold for 1,000. So again, instead of 500, it's 1,000. For consolidation entry G, we eliminated the overstatement of inventory and we removed the gross profit step up by debiting cost of goods sold and crediting inventory. That kind of makes all of this happen, and notice here, TI will remove that, G's will remove that, and then P's would remove that. So at the end of the day, we've done all of our entries that removes those intra-company transactions. In the next video, we're going to talk about situations in which the subsidiary actually doesn't sell all of the goods or sell some of the goods and are left with an amount.